In today's video, I'm going to show you once again how powerful a professional price action analysis can be. The analysis will be on the 15-minute chart of the British pound versus the US dollar, but the same tools and rationale can be applied in any market and any time frame that you wish to trade, because we are dealing with the mathematical structure of price and the basic supply and demand mechanism that underlies any market. The idea is to find places in the chart where line work agrees with the overall context of what the market is doing. When the trader is able to detect a story between buyers and sellers in the chart, the analysis becomes much easier and all the other tools make sense. As usual, the first thing we want to detect is the major and minor flows of the market and what they are doing in relation to one another. From numbers 1 to 3, we can clearly see the major flow creating a higher high, therefore rendering low number 2 as a level where major buyers have proven themselves against the sellers. We can also see that after high number 3, price begins to fall back down, and that implies the question of how large the pullback will be, and also if buyers are still going to hold their ground against the sellers. This is a tricky market because there is one major flow, but we can actually detect two different minor flows happening at the same time. Within the 2-3 price vector, we have a flow smaller than the major flow we just talked about, but after high number 3, we have an even smaller flow. One of the problems of trading with price charts is that market flows of different magnitudes are superposed on top of each other, and that creates some confusion because sometimes the movement of price doesn't seem to make any sense. It's not that it doesn't make sense, it's that the superposition of different simple mechanisms on top of each other create a nonlinear dynamic, just like in a double pendulum, for example. The mechanics of a simple pendulum are simple, but when you add one pendulum to the other, you create a chaotic mechanism. The way professional price action traders get around this problem is by waiting for all market flows to achieve the same state, or at least to wait for them to give each other room to travel. That is, of course, the most difficult thing about price action trading. Once you are able to do that, it's easy to find a line work. After number 3, we can see that price came back down and it's now stopping at the support line formed by the medium flow. The minor flow after number 3 is stopping on that support line, but that doesn't tell us anything about the major flow. For all intents and purposes, we want to find moments where all of these different types of flows align, and then we can talk about a high-quality trade opportunity. If you keep trying to scalp the market in the middle of nowhere, you will get run over by the jittery motion and noise that the different types of flows create, so you are much better off waiting on the sidelines for the correct opportunity. The major buyers that create the 2-3 price vector are still down there near low number 2. For a fast pullback to be valid in terms of the major flow, price would have to come all the way down near the low number 2 for all types of market flows to align. One thing that can change the level where buyers might show up again is the simple passage of time. The longer it takes for price to retrace back to the theoretical level of where major buyers are sitting, the higher the level where these buyers can appear. We can observe this more objectively by plotting an Andrew's pitchfork on the market extremes, marked by the numbers 1, 2, and 3. Since we are looking for the upward motion of major buyers in this case, we need to modify the Andrew's pitchfork. The moment we modify the pitchfork, a few things start to become clear. The horizontal line we are at right now represents a bump for the minor and medium flows, but it's not important for the major buyers that are in a lower level. The lower line of the modified Andrew's pitchfork shows the relationship between the demand line formed by buyers and the simple passage of time. The more time passes by, the higher the demand line, since we are talking about an upsloping pitchfork. Ideally, we want market context and line work to intersect in one single place in the chart, where I have a logical place to put a stop loss order and a lot of headroom for price to travel in our favor. Beyond that, watch how the lower line of this modified pitchfork catches the frequency of the lower tails near major low number 2. Let's advance price to observe how the market develops from this point onwards. Here we have an interesting situation that can also be a bit confusing if you are not aware of the counterpoint between different types of market flows. Notice that price is flirting with the center line and the lower line of the modified Andrews pitchfork, but before that, the medium flow started to create expanding highs and lows. If you don't have the goal of waiting for price to reach a point where all market flows agree, you are probably going to get caught in the expanding highs and lows. The problem with this type of formation is that it messes up the textbook definition of trend. In an upward trend, we have higher highs and higher lows, and in a downward trend, we have lower highs and lower lows. An expanding formation displays higher highs and lower lows. So the trader has no idea about the actual direction of the market. However, that's the wrong question to ask because we are not so worried about the market direction per se, as we are worried about the places in the chart where all the different types of flows intersect with each other. The first time price touches the lower line of the modified Andrews pitchfork is the place we are looking for because that's where the major upward demand line intersects with the median and minor horizontal support line. Observe that if the trader waits for the moment where all things correlate, he can filter out most of the noise in the charts and avoid being stopped out unnecessarily. At the lower line of the pitchfork, we can see the appearance of a fractal bar and a long lower tail that implies buying pressure. We can also deploy a smaller Andrews pitchfork here to add yet another confirmation that this is indeed a reversal point. By placing a pitchfork in the last legs of the expanding pivot formation, we can see that price reaches the center line of this pitchfork at the same time it reaches the lower line of the large fork. The entry for this trade could be made at the open of the very next bar or at the second touch of the lower line of the pitchfork, which doesn't always occur. The stop loss could be placed a few pips below the fractal bar with a target at the center line or the upper line of the larger pitchfork. So let's see how price develops. Here we can see that price ends up going to the upper line of the pitchfork. The bottom line here is that we filter out the noise of the market by looking at where the different types of flows intersect. We can observe that with the market context and with the supporting line work. If you want to learn how to trade using these techniques, check out the courses available in the video description. You can visit my website fractalflowpro.com to see the table of contents and the testimonials from students. If you enjoy the videos I produce and wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, share the video with your trading community, and leave your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.